claim deduction, 48 disallowance would not trigger. The same ratio or logic to my mind would apply here. And if deduction is not claimed in respect of an interest, then this limitation of interest rule would not apply.
What happens if this company is a MAT company? This company paying interest is a MAT company and it is paying. Then would it be under MAT provisions also disallowed, or what?
You see, any transfer pricing disallowance does not result in a corresponding adjustment under section 115 GB. So there would not be any trigger.
From a thin capitalization norms point of view also.
No, there is no corresponding adjustment provided under section 115 GB.
No, but it also says that this should be in respect of interest payable, which is deductible in computation of income under the head profits and gains of business. So for MAT, you don't separately compute income under different heads.
There is a major issue with regard to, let's say, MNE is having one single bank. This is a major problem. They have one bank where, whether it is Western Europe or the US, they have one bank and one is their principal partner. Invariably, the relationship is sorted out by
Head office.
the MNE at that principal headquarters with their concerned banking partner. All subsidiaries throughout the world follow the same banking partners because all of them have branches throughout the world. So in that case, this proviso will definitely be applicable. You know that
Guarantee.
guarantee.
Implicit or explicit.
Yeah.
The adjustments that we are talking about, the carry forward, how would it be adjusted in future years?
Say for instance in the same very example, this excess deduction which is disallowable is in the second scenario is 30. So this 30 can be carried forward up to 8 years, and say in the subsequent year the similar thin capitalization limit is threshold is worked out, and if there is a deficit of say 10, then you can set off the interest to the extent of 10 rupees in that year, and so on. 30.
For example, in a third year.
30 is your disallowance.
Correct.
This 30 you can carry forward for 8 years.
Correct.
So now up to 8 years, if when you work out this 30% of EBITDA, 30% of EBITDA, interest paid in excess of 30% of EBITDA. So 30% of EBITDA, let's come back to the first scenario. So amount of interest paid, 30% of EBITDA is 30.
Correct.
And if you have paid interest, only a percent of interest to that extent.
So, for example, if there is I have a scope of 10, so my normal income would further go down by 10?
No, so then you would not, you will claim a higher deduction. This is what.
So normal income will go down by 10.
But go down by 10 in that year.
Yes.
In the later year, yes.
So thin capitalization rules generally have been adopted by developed countries such as Australia, France, Germany, and other OECD countries, and US and UK. This is, to my mind, would operate as a double-edged sword, in a sense that while it is a good tool for protecting the tax base, it would be at the cost of the foreign inflow of foreign funds, because the cost of funding, then the funding the projects or infrastructure projects which with large gestation period would be difficult. So that's the flip side or consequence of this provision. The third proposed amendment which we deal is secondary adjustments. Secondary adjustments under the transfer pricing parlance really means actual allocation of profit consistent with the primary transfer pricing adjustment by way of a constructive transaction or a secondary transaction, as we call it. I'll just try to explain that in a transfer pricing adjustment, say for there is a for instance a payment of royalty, there is a transfer pricing adjustment happens. So that adjustment is a primary adjustment. Now, the secondary adjustment, which in several cases transfer pricing officer used to attempt, was that to treat this adjustment as loan or advance given to the associated enterprise, and to that extent they would charge or impute interest in respect of such secondary adjustment. Now, hitherto the transfer pricing provisions in India did not provide for such a secondary adjustment, and therefore courts in many cases have not been entertaining such kind of secondary adjustment. One, recently Mumbai bench of the tribunal in case of PMP auto components had negated such an attempt of making secondary adjustment made by the transfer pricing officer, and possibly this has prompted the government to implement this, bring in this secondary adjustment regulation or law in our transfer pricing regulations. So, section 92 CD is proposed to be introduced by the Finance Bill 2017 to bring in the regime of secondary adjustment under the transfer pricing regulations. Section 92 CD provides that a secondary adjustment in cases where primary transfer pricing adjustment in excess of 1 crore or 10 million or more has been made suo motu by the taxpayer in the transfer pricing study, or by the assessing officer and has been accepted by the taxpayer, or the transfer pricing adjustment is worked out in respect pursuant to the APA which assessee enters into with the competent authority, or as per the safe harbor rule, a transfer pricing adjustment is crystallized or worked out, or through because of the MAP there is a transfer pricing adjustment happens. So in such situation there would be apart from the primary adjustment which transfer pricing adjustment which is increasing your taxable income, there would be another secondary transfer pricing adjustment by way of treating this primary transfer pricing adjustment as an advance on which interest would be imputed. So if the amount of primary transfer pricing adjustment which has crystallized by in terms of these 5 situations which are provided, if within the prescribed time the said amount is remitted by the associated enterprise or respective associated enterprise, then there would not be any secondary adjustment. But by within the prescribed time limit, if such amount is not remitted by the associated enterprise, then this would be treated as an advance or loan, and then on that interest would be computed in the prescribed manner. So this is to be prescribed. I mean, not yet prescribed. This is prescribed in the rules.
And the Supreme Court, higher authority, decide against the SSC. Then the provision provides a suo motu by the taxpayer, and the assessing officer accepted by the taxpayer. So, in case, can we interpret the accepted by taxpayer after the Supreme Court, or in that case the addition will not be made on the secondary adjustment?
No, if it is decided by the Supreme Court, then it would amount to acceptance by the taxpayer, and then that's the law of the land. So beyond this, there cannot be any dispute. So that would be an acceptance. By operation of law.
If the taxpayer is not accepted as litigating and the matter goes up to Supreme Court, then the issue is whether, first of all, you wait till the Supreme Court, and the Supreme Court decides against you. So you have not really accepted, but Supreme Court has said. So it would still be considered a primary adjustment. Yeah.
to my mind, it will be considered as acceptance of the primary adjustment by operation of law.
Here the word is actual profit is mentioned. And thereby removing the imbalance between cash account and the actual profit of the assessee. Can this adjustment be called as an actual profit?
No, this is a notion. This is not an actual profit. This is a notional.
That
No. That.
thereby removing the imbalance between cash account and the actual profit of the assessee.
No. This is the purpose of this secondary adjustment. You see, when there is a. No. This is how even OECD explains a secondary adjustment. The purpose of secondary adjustment is that when a primary transfer pricing adjustment happens, that's also a notional adjustment. The money does not come in.
No, you see what they are saying is you have paid certain amount. Now the ALP is lower, you have paid a higher amount. So actual profit should have been calculated with reference to the lower amount, which is the ALP. So once the ALP is crystallized, actually you should have paid only that much, but you have paid a higher amount. So therefore the actual profit is to be reckoned with reference to the ALP determined.
If the to the extent of primary adjustment, the amount is remitted, then your cash profit and actual profit, which is determined as per the arm's length principle, become the same.
Same, correct.
So if that amount is not remitted, then there is a secondary adjustment. No. Actual profit is the actual profit which would be arrived at on the basis of arm's length principle. So that's the real profit which you should have earned.
Right.
Hello, Neeraj.
Yeah.
Just one small case I just want to say. Suppose there is a transfer pricing adjustment made, an assessment has been done, and in the court of law, ITAT remands it back to the transfer pricing officer. Now, when this provision is coming into place, transfer pricing officer again makes an addition after going through the directions of the ITAT. Can he now make a secondary adjustment?
No, that primary adjustment which is made revives. No? When it is set aside, it is temporarily, it is not there. And after he repeats the adjustment, then the primary transfer pricing adjustment again.
No, I think your point is that this the primary adjustment relates to a year prior to coming into force of this section.
Yes, prior to that.
So I think this amendment will apply from assessment year 18-19 onwards only. It should not apply to matters which are sent back. He can't make a secondary adjustment with respect to those recomputation.
The primary adjustment, actually this answer is provided in the statute itself. It says that it would apply to primary adjustment which relating to transactions for the financial year 2015-16 or before. It would not apply to primary adjustments made in relation to transactions for the financial year 15-16 or before. So if it pertains to the primary transfer pricing adjustment pertains to financial year 15-16 or any earlier financial year, then there is no question of applying the secondary adjustment. Only in relation to transaction entered into after 1/4/2016, secondary adjustments provisions can be applied. Now, there can be an issue in most of the cases. The transfer pricing studies or benchmarking analysis are undertaken on applying entity-wide transactional net margin method, and a combined analysis is undertaken bunching several international transactions undertaken with different associated enterprise. There is one transfer pricing adjustment which is computed in the transfer pricing assessment, which may relate to several international transactions with several associated enterprise. So the question would be that how much amount is to be remitted by which assessee. So possibly a rational basis of allocation of transfer pricing, the combined transfer pricing adjustment would have to be made, and there is a possibility of debate or dispute with the tax officer or TPO as to how these transfer pricing adjustment would be allocated to which assessee. secondary adjustment which are made, as I was explaining, is only made for tax purposes or transfer pricing purposes. On its own, it does not require making any entry or recording any entry in the books of account. So books of account would be affected, or an entry would be recorded in the books of account when a remittance is made in relation to the primary adjustment to avoid this secondary adjustment. So if there is a transfer pricing adjustment made in respect of payment of royalty, and that amount or export, and that to the extent of that transfer pricing adjustment, there is a remittance made by the associated enterprise. To that extent, and that amount naturally would be credited to the profit and loss account, and to that extent your profit and loss account would show an increased profit, and that would have its own consequences. In a sense that when a remittance is made to the extent of the primary transfer pricing adjustment by the associated enterprise, so one has suffered already a transfer pricing adjustment, a tax has been paid on that. When a remittance comes in under the normal provisions of the Act, this may amount to taxing the same income twice, which to my mind would not be possible, and it would be possible to claim reduction of the profit as per profit and loss account for computing on taxable income under the normal provisions of the Act. However, there would be an issue when you are in a MAT situation. So, to that extent, to the extent of remittance of primary adjustment, your book profit would be showing a higher profit figure, and there is no corresponding adjustment which is provided under section 115 JB. So, for the purpose of book profit, possibly as the law as it stands today, you would end up paying higher tax under MAT provisions. Then there can be another issue or difficulty which may arise, in a sense that when international transactions are entered into and which are subject to tax withholding here, for instance, payment of international transaction of payment of royalties which are subjected to tax here, then subsequently there is a secondary adjustment, or there is a remittance made by the associated enterprise in relation to, I'll just finish, in relation to such international transaction, then it would possibly not be possible to withhold, to get a refund of tax withholding. One would have to see whether there is a time available with the associated enterprise, foreign associated enterprise, to revise his return and claim refund of excess taxes which is paid. So all these issues which may come up, and therefore this one has to see the rules, and one may see how the government addresses these issues which would arise on implementation of these such provision. In the end, I would say that as such, this is a harsh provision, for the reason that it is leading to taxation of notional income, and then possibly in terms of the clarification which is available from OECD, the corresponding adjustment would not be available to the associated enterprise in respect of such provisions. And therefore this is for that reason only few developed countries have implemented in their domestic law secondary adjustment provisions. So this is to that extent it would have a significant impact on non-compliance of transfer pricing provisions, and that brings me to the end of my transfer pricing provisions.
I'll request Rohit Jain to deal with the remaining provisions. Thank you.
Thank you, sir. Good evening, friends. Continuing with our proposals, the direct tax proposals, now I'll deal with some of the amendments which have taken place in the capital gains. One major amendment which has been done, which probably may not have been noticed, is the amendment in section 1038. Now we all know that under section 1038, when you transfer the shares on a stock exchange, which are subjected to STT, they are exempt from tax. Now there is an amendment which they are seeking to make. With the proposal is that this exemption will not be available to you unless the acquisition of the shares itself was subjected to STT. Now this STT came into force from 1st October 2004. So therefore, whatever shares you acquired after 1st October 2004 and which were not subjected to STT will not be exempt from tax under section 1038. Now, if you see, the word used is acquisition of shares after 1st October 2004. Now there can be so many modes of acquisition. You may have acquired the shares by way of, say, gift. You may have acquired the shares by way of will, inheritance. There may be mergers, there may be acquisitions. So there can be so many ways where you could have acquired the shares, but now the condition which has been imposed, which is they are seeking to impose, is that the original acquisition has to be subjected to STT. Now in the memorandum what they clarify is that to protect the exemption for genuine cases where STT could not have been paid, like transaction of acquisition of shares in IPO, FPO, bonus or right issue, by a listed company, acquisition by a non-resident in accordance with FDI policy, etc., shall be notified. Now there are exceptions which are to be notified, but we actually don't know what exceptions they are going to notify. So this probably requires a proper representation to the government, that according to us we have identified some of the exceptions which should be notified. For example, shares acquired pursuant to merger and demerger. So if this exception is not notified, actually a tax neutral demerger or the mergers fails, because ultimately at the time of transfer of the shares which you acquire at the time of merger, they will be subjected to capital gains tax. You will not be able to get the benefit of 1038. Similarly, off-market transactions in private deals, they may not notify this transaction, but preferential allotment to investors, that should also be notified. Shares which are granted, which you receive by way of ESOP, so in that you don't pay STT. So this also should be notified. Then shares acquired in a private company which got listed subsequently. Then shares which are exempt under section 47, like for example shares which you receive by way of gift, or shares which are settled in a trust, they are not treated as transfer under section 47, and you don't pay STT at the time of acquisition. So therefore this needs to be notified by way of inheritance or will. For example, partition of HUF, you get the shares, but they are not subjected to STT. So therefore that also needs to be notified. Transfer between holding and subsidiary. These are all transactions which are exempt under section 47. So according to us, basically all the transactions which are notified under section 47, which are exempt transactions and which are normally not subjected to STT, they should be notified as the exception category, and they should still be given the benefit of the 1038 exemption. Actually, the background of this 1038, which probably appears to be, is that they wanted to curb the practice of these penny stocks, which were actually under the scrutiny. There was a SEBI reports also that people were misusing the listing platform of the shares being given, money being laundered, the shares being listed, and thereafter the transfer taking place at the jack-up price. So the SEBI had notified some of the companies which were actually floated by some of the people only to launder the unaccounted money. This provision actually probably has been incorporated to curb all those transactions. But while curbing this, the intention is actually not matching with the amendment which has been proposed. It is actually hurting all the genuine transactions where the shares are acquired without payment of STT. So this actually requires a serious notification of various exceptions which should still be eligible for the exemption under section 1038. So this, according to us, is one of the major amendments which has been done. Going forward, this is a welcome amendment. Actually, in fact, if you will see under the direct tax code which was earlier proposed, this was one of the proposals where they wanted to shift the cost inflation index from 1481 to 2001. The major impact of this is, presently when you transfer a property, you adopt, for a property which is acquired prior to 1481, you adopt the fair market value as on 1/4/1981. So that actually incorporates all the inflation aspect up to 1/4/1981, and thereafter the index factors are applied and the index cost of acquisition is determined. Now that base is being shifted from 1/4/81 to 2001. So the immediate effect would be, if you have acquired the property prior to 1/4/2001, you will have to get your property valued as on 1/4/2001, which will be fair market value, and that will be subjected to indexation factors. So you will get your cost will be much more, and which will reduce the burden of capital gains tax. They have not clarified whether the indexes, they are going to re-notify the indexes with reference to 1/4/2001. Even if they don't notify, we can still adopt 2001 index as the denominator, and the numerator would be the index of the year in which the property is sold. Now this is one major amendment which is a welcome amendment which has been done. Just to give a brief background, normally what happens is, if I say I am a holder of a land, I want to get the land developed. So I enter into a joint development agreement with a builder, whereunder there can be various kinds of arrangement with the builder. One arrangement could be that I pool in my land, the builder constructs the property, and out of the constructed area he gives say 20% or 30% to me, which I can further sell. Or there can be other situation where I may be a part of one of the cooperative society which is having a pool of land, and whereunder all the cooperative members actually ultimately are given a flat in the constructed property. This was actually a live situation at a very huge litigation which we handled in Chandigarh, where a cooperative society had a pool of land, and the land was pooled together and given to a builder. Under the agreement, the builder was supposed to pay certain consideration in cash by way of check, and he was supposed to give one flat to every member of the society. What the department did was, they brought to tax the entire consideration, not only the amount which was paid initially, but also the value of the flat which I was supposed to receive 3 years or 4 years down the line as capital gains tax liability in the year in which I gave the possession to the builder. They said that in terms of section 247(5), as soon as you hand over the possession of the land to the builder, at that stage the transfer gets triggered, and therefore since you have given proportionate rights in your land, there is a transfer of the land, and therefore you are liable to tax on the capital gains tax liability. So this matter travelled to the High Court. In fact, High Court decided in our favor, holding that the possession in that situation was given only for the purpose of joint development. It was not possession in terms of 53A of the Transfer of Property Act. But this issue is a very highly contentious issue, because there is a Bombay High Court in the case of Chaturbhuj, which has clearly held that once you hand over the possession to the builder in terms of the joint development agreement, the transfer triggers at that point itself. Now to take care of that kind of a situation, what they are now proposing to amend the definition, to amend the taxability of capital gains, and it says that capital gains is, they say this is the new amendment. They are proposing to amend to insert a new section 5A to provide that in case of an assessee being an individual or a Hindu undivided family who enters into a specified registered agreement for development of a project, the capital gains shall be chargeable to income tax in the previous year in which the certificate of completion for whole or part of the project is issued by the competent authority. So after the amendment, what will happen is, the capital gains will not be taxed in the year in which I hand over the possession to the builder. It will get deferred to the year when the certificate of completion is given by the competent authority, and that time I will be given the cash consideration, and I will also have the in case some constructed proportion is given, that will also be come to me. Now for the purpose of computing the capital gains, what they say is that the monetary consideration will be considered as part of as your consideration, plus the stamp value of the property which is given by the builder, that will be considered as your total consideration. and based on that the capital gains computation will take place. Now there is a proviso which has been inserted, and this is an important proviso. So for example, I enter into a joint development agreement with a builder, but I transfer my rights under the JDA to another party before the completion certificate is received. In that situation, this benefit will be withdrawn. So your deferment which has taken place because of you are entering into the JDA and you are availing of this benefit of new subsection 5A of 45 will get withdrawn, and you will be subjected to tax under the normal provisions. So the effect according to us would be, we have just given an example over here. So for example, you hand over the possession in assessment year 2018-19 and you avail of this benefit. So your capital gains tax liability is not charged in 2018-19. Now the completion before the project is completed, say in 2020-21, you transfer your rights in the JDA to a third party for a consideration. In that situation, two tax liabilities will get triggered at that point of time. One, your rights which you are transferring to another party under the JDA, that will be taxed based on whatever consideration you receive from the third party. Plus, secondly, the exemption which was allowed to you, the deferment which was allowed to you earlier, will stand withdrawn. So in 2018-19, when you handed over the possession, you will be subjected to tax on the capital gains tax liability because that will be the triggering point of treating it as transfer. Now the modality, while they have inserted this proviso, but the modality is not clear. Modality in the sense that in 2020-21, if I were to transfer my rights in the JDA to a third party and the benefit gets withdrawn, so I am required to be subjected to tax in 2018-19 on the original as per the existing law. Not the time limit for filing your revised return has expired by that time. So there may be issues at that point of time how to offer that amount to tax in an earlier years. So those issues probably have not been captured as of now in the finance bill. So this is what we have specified. So the amendment needs further clarification with respect to two things: whether the capital gains be taxed at two stages, namely, firstly in the year of possession with reference to the difference between the stamp duty valuation and the cost of acquisition, and secondly in the year of transfer of right on difference between consideration received and the stamp duty value paid in the year of possession. What would be the period of holding on sale of right in the share to a third party? According to us, because when you transfer under the JDA is only your rights under the JDA. You don't transfer the land and building at that point of time, because land you had transferred earlier to the builder when you entered into the JDA. So therefore, the period of holding of your JDA, period on which you enter into the JDA until the date you transfer, that period will be considered whether it is short term or long term. So this is in so far as this important amendment is concerned. So, sir, you want to say something? Now, going forward, the another important amendment which has been done in the capital gains tax liability is the clarification with regard to the conversion of preference shares into equity shares. Now, if you see the Act presently in section 47, there is no specific clause covering a situation where preference shares are converted into equity shares. There is a specific provision dealing with conversion of debenture stocks, etc. into shares of a company, but there is no specific clarification with regard to the conversion of preference shares into equity. Prior to this amendment also, in fact, we had been taking a view because of there being a specific provision in section 55, which says that on conversion of one form of shares to another form of shares, the original cost will have to be adopted. So the view which we have been taking was that the conversion actually does not result in any tax incidence. But there were conflicting judgments of the courts. There were certain judgments of the high courts which said that on conversion of preference shares into equity, technically there is a transfer which gets triggered, and therefore they are subjected to capital gains tax liability. But on the other side, there was a tribunal judgment which said that that transaction will not result in a transfer. Now what they have done is they have in fact clarified, there is a specific clause which they are seeking to insert to provide that in case of conversion of preference shares into equity shares, that transaction will be exempt from tax. And they have also clarified simultaneously that the period of holding shall be reckoned from the date of preference shares was acquired by the SSE. So therefore, you get the benefit of the period of holding from the earlier date also. So these are all the judgments which we have mentioned. You will get it as part of the handout. Now, FMV of listed shares. Now, this is again an important amendment which they have done. Now, the earlier circular, because earlier the Act, there was no clarification. Act, there was no specific provision, and this amendment has taken place from 1/4/2018. One can probably argue based on this amendment that they have, actually it is more of a clarificatory amendment, because there was already a circular, this 1964 circular, which said that on conversion actually there is no transfer which takes place. But then the matter is litigative. We have mentioned 3 judgments, one of the Bombay Tribunal and 2 contrary judgments of the High Courts, wherein they said that yes, technically there is a transfer which takes place. Now, FMV of unlisted shares. Now, if you see the existing provisions for computation of capital gains, for calculating the capital gains, we adopt the actual consideration what is received. So, for example, if I were to transfer the shares of a company which has a fair value of 100 at say 10 rupees, I cannot be taxed at 100 rupees, I can only be taxed at 10 rupees, because what I have actually received is only 10 rupees. Now, they are seeking to amend the law, and their new section is sought to be inserted in 50 CA to provide that the fair market value of the shares will be adopted for the purpose of computation of capital gains tax liability. Now, the important thing to note over here is that once I purchase the share, once I sell the share, say for having a 100 rupees fair market value at 10 rupees, I will be subjected to tax at 100 rupees because of the new amendment. And simultaneously in the hands of the recipient, section 56 get triggered. And because he is receiving the shares for less than adequate consideration, in that situation, even he can be subjected to tax on the difference between the actual consideration which he has paid and the fair market value of the shares. So this actually will lead to more of complications in the hands of the seller as well as in the hands of the buyer. And in fact, this may lead to double taxation also. Now, 54 EC sought to be amended to actually to expand the scope. Presently, only the bonds of National Highway Authority and Rural Electrification Corporation are there. So they are seeking to notify further bonds for the purpose of 54 EC exemption. No, 100 rupees. Yeah, in the case of?
If the recipient does not pay
No,
tax,
he pays only 10 rupees.
No, if he pays
But
tax under 56 or
Then-
100,
then.
then he can be treated, then the cost can be 100.
In
If
case-
he pays tax under 56.
Because otherwise he has only paid 10 rupees. So his cost cannot be 100 rupees just because the seller has been subjected to tax at 100 rupees. Now moving on, there are few amendments in the provisions relating to search and seizure. Presently there is an ongoing controversy as to whether the reasons which are recorded by the sanctioning authority before issuing a search warrant can be given to the assessee or not, or whether it can be produced, whether it can be given to the assessee or not, whether it can be produced before the tribunal or not. Now, there was controversy as to whether or not I can challenge the validity of the appeal before an appellate forums. Now, there are conflicting judgments of various courts. The Delhi Special Bench held that the tribunal has no competency to go into the validity of the search, and there are High Court judgments also. But a contrary view was taken in various Karnataka, Rajasthan, etc., wherein they said that since search assessments are based on a valid search, so therefore the tribunal is also equally competent to go into the validity of the search. In fact, in a recent case of SD Aluminium, which we have mentioned over here, the Supreme Court observed that since the CIT appeal examines the validity of the search assessments, so therefore CIT appeal is